Hello everyone and welcome to this lecture on ISA 315. Today we are going to explore one of the most important standards in auditing, identifying and assessing the risk of material misstatement through understanding the entity and its environment. This standard is central to audit planning. It explains how auditors gain an understanding of the business they are auditing, the environment in which it operates, and the internal controls it has in place. Also, the auditor can identify where material misstatements might occur. In simple words, ISA 315 guides us on how to study the client's business, spot the risk, and use that knowledge to plan audit effectively. ISA 315 deals with the auditor's responsibility to identify and assess risk of material misstatement in the financial statements. These risks could arise due to fraud or error, and they can exist both at the overall financial statement level and at the assertion level. That is, for specific classes of transactions, account balances, and disclosures. The standard applies to all audits, regardless of the size or type of the entity. The objective is very clear. The auditor must identify and assess the risk of material misstatement by understanding the entity and its environment, including the internal control system. This understanding provides the foundation for designing and implementing audit procedures that respond appropriately to the identified risk. You can't audit effectively if you don't first understand the business and its risk. ISA 315 introduces a few important definitions. Let's break them down. Number one is assertions. These are the claims or representations made by management in the financial statements. For example, when inventory is reported at 1 million, management is asserting that this inventory exists and is owned by the company and is valued correctly. Business risk, any risk arising from conditions, events, or actions that could threaten the entity's ability to achieve its objectives. For instance, a sudden change in regulations, loss of a key customer, or entry of a new competitor could all be business risks. Number three is internal control. The processes are designed and maintained by management to provide reasonable assurance that objectives will be achieved. Internal controls covers reliability of financial reporting, effectiveness of operations, and compliance with laws. Number four is risk assessment procedures. These are audit procedures performed to gather information about the entity, its environment, and internal control to identify risk of material misstatement, whether due to fraud or error. Number five is significant risk, a risk that, in the auditor's judgment, requires special audit attention. Example includes risk of fraud or highly complex transactions. ISA 315 requires auditors to perform specific risk assessment procedures to identify potential risk of material misstatement. This includes inquiries, asking management, internal auditors, and other staff for information about possible risk, and analytical procedures using data analysis to spot unusual trends or relationships. For example, a sudden jump in expenses without a clear reason could signal risk. And also observation and inspection, looking at documents, reports, and even the client's facilities to gain insights. It's important to note performing these procedures does not give enough evidence on its own for an audit opinion. They only help us plan the audit more effectively. Understanding the entity and its environment. To properly assess risk, the auditor must develop a deep understanding of the entity. This includes industry regulation and external factors, for example, economic conditions, laws, tax policies, or environmental regulations, and nature of the entity, like its operations, structure, ownership, financing, investments, and business model. And also accounting policies, how the entity chooses and applies accounting policies and whether these are appropriate and consistent. Also objectives and strategies, like what the business is trying to achieve and the related risk that could threaten those objectives. Measurement and performance review, like how the entity measures its success. For example, if management is focused heavily on profit targets, that could create pressure and increase the risk of misstatements. Now, a very big part of ISA 315 is about internal control. Auditors must understand internal control relevant to financial reporting. The standard breaks this into five components. Number one is control environment. This is the overall tone at the top. Does management promote honesty, ethics, and accountability? And number two is risk assessment process, like how management identifies and responds to business risk. And number three is information system and communication, how systems record and report transactions and how financial reporting roles are communicated. Number four is control activities, like specific policies and procedures such as authorizations, reconciliations, or IT controls. And number five is monitoring of controls, how management monitors and evaluates whether controls are functioning effectively. For each component, the auditor must evaluate the design and determine if controls have been implemented. Once the auditor understands the entity and its controls, the next step is to identify and assess risk. Risks are assessed at two levels: financial statement level, risks that affect the overall financial statements, for example, management override of controls, and assertion level, risk relating to specific balances, transactions, or disclosures, for example, valuation of inventory. Auditors must consider the likelihood of misstatement, the magnitude of potential misstatement, and whether the risk is pervasive or limited. Some risks are so important that they are labeled significant risks, requiring special audit attention. Examples include fraud risk, complex accounting areas like related party transactions or unusual transactions. Risk assessment is not a one-time step. If new evidence arises during the audit, the auditor must revise the risk assessment and adjust audit procedures accordingly. Finally, auditors are required to document like the key discussions among the audit team, the understanding of the entity and its internal control, the identified risk and how they were assessed, and also the related controls that were understood and tested. This documentation provides a record of how the auditor reached conclusions and ensures audit quality. To sum up, ISA 315 emphasizes that auditing starts with understanding. By studying the client's business, its environment, and internal controls, the auditor can spot where immaterial misstatements are most likely to occur and design appropriate responses. So remember this key point: a good audit is built on a solid understanding of the entity and its risk. With this, I conclude this lecture on ISA 315 and Allah Hafiz.